Hi, I'm Des Dowling. Welcome to Melbourne Property TV, the second episode in our exciting second series. Tonight, we're in the suburb of Oakleigh, a fascinating multicultural suburb in Melbourne's southeast. Our panel of experts will look at the recent share market downturn and ask, what's the better investment, property or share? Welcome to today's panel, where our topic is shares versus property investment. Which is the better thing to do? Joining me on the panel, finance journalist James Dunn, from the REIV, Robert Larocca, and from Empower Wealth, Ben Kingsley. Thank you, gentlemen, for joining us on the panel. Throw over to you first, James. What's the better investment at the moment? We've got a soft property market, we've got the share market jumping all over the place. Where do you put your money? Under the bed?
Well, I think the dichotomy of shares versus residential property, I don't think that's really appropriate. That's often beat up that way. I mean, these are things that investors can use, either of them, and possibly should. I mean, diversification, the more asset classes, the better for an investor. So let's get that out of the way for a start. Don't really like the Steve Keen, Christopher Joy slug it out for world championship supremacy, which asset class. Because, as I say, people should be able to use them both. But definitely have a soft property market, definitely got a soft share market. I've got to say, I've always thought the share market is far more accessible because you can put any amount of money into it any time, and generally that helps small investors.
And you can access it.
You can access it.
And the transaction costs are not.
Transaction costs are lower, etc., etc. But it's a very soft market at the moment too, and the volatility, the second wave of volatility that's really bashing the share market post GFC. I don't think that's going to change anytime soon. Also, I think people have lost their blind faith in residential property, and ultimately I think that's got to be a good thing. This idea that property can only go up and you will always be able to sell a residential property for more than you paid for it, I think that blind faith being tested and maybe being disproven is a good thing.
Well, timing is everything, of course, in any of those sorts of investment categories, because you pick the right time or the wrong time and you can end up in a much worse or better position than you started from. We had a look at property versus shares to do that equation over a 20-year period. RMIT University had a good look at both of the classes and found that you got a slightly better return out of property over a 20-year time frame, and suggested that that would make it a good inclusion in anyone's portfolio because it minimised the volatility. They also found that in most of the sort of subcategories they looked at, that it moved sort of counter-cyclical. So, a downturn in the stock market was not followed automatically with a downturn in the property market. So there was some good news there for people looking at the medium to long term.
But Robert, wouldn't you say it seems a unique time at the moment with the GFC and now what's happening in Europe with the Euro countries? Well, and now we're being told that we're in the middle of a real estate bubble, or that the market's softening and will continue to soften. Do you think these have been uncharted waters at the moment for people?
To an extent, but I mean, just look at the recent history and you realise that property is not that bad. I mean, the GFC prices did go down, and median price went down about 14% in Melbourne, but as soon as the economy righted itself, it rocketed back up because of the underlying factors in the residential property market. So just like when you're buying a stock and you need to look underneath the stock price and say, what is that stock? What's being made? What's being sold? You also have to do that with property and go, what are the underlying fundamentals in the Melbourne market? Because they're different to Sydney, and they're enormously different to America and the United Kingdom.
Ben, what's the experience with your clients? Is there panic out there?
There's definitely not panic. I mean, our clients are investors, so it's actually, we like to go against the grain when it comes to investing and advising our clients the time to buy is when there's less competition in the market. So we're seeing, the share market changing sentiment around people's investment attitudes. For our, educated investors, it's actually a great time to sort of be looking around. And I sort of make the point around property is property is not a general market. You're only buying one asset out of potentially millions. There's 8.6 million dwellings in Australia. You only get to buy one.
So depending what you read and when, the interest rates could go up or down. What's your gut feeling?
Yeah, I think interest rates are going to remain steady for a while. I don't buy into the whole story that, the economy's in such bad shape But there's certainly some issues around sentiment, consumer spending. There is definitely an area of the population that's struggling at the moment, and that's the people in that affordability range where interest rates are slightly higher than what they bought their properties earlier on. So your first home buyers, your mortgage belt type people, they're going to, they are really hurting, and they're the ones who are obviously reducing their consumer spending to meet their mortgage obligations.
James, what do you think interest rates? I mean, they're always seen as, there's screaming when they go up 0.25%, or we see the battlers on the front page of the Herald.
That's right. I mean, every time the interest rate is lifted, there's the news crews are straight out to the people who are complaining about another 0.25% on their home loan, etc. It's never looked at from the point of view of depositors on the other side of the balance sheet who, finally after 30 years feeling some love from the banks in higher interest rates. But just interest rates is really interesting because you did have that feeling everybody was building towards that, inflation, the speed of the mining part of the economy is really kicking inflation along. We have to crush that. And remember back in 1991, that was their prime driver for lifting interest rates that high. It was a Pyrrhic victory to beat inflation but kill the rest of the economy. And it's almost like they were going to repeat that mistake, that focusing on inflation because of the speed of the resources side of the economy, not realising that most other areas of the economy were softening like a blancmange. And now they seem to have picked up on that. And so I'm with Ben. I think they have to sit on the sidelines now for a lot longer than their rhetoric was pointing to even just a couple of months ago.
I mean, it was 2008, I remember clearly. Each, couple of months, the interest rates went up and up and up, and it really did impact the residential property market. And, of course, that year ended with the GFC, so it was a bit of a year of horrors from the property perspective. But this year's been confusing. I'd, forgive any sort of residential investor or homeowner for being confused, because the first half of the year, they're going up. Now they're going down. So we've adopted a believe it when you see it approach, because I ultimately don't think a lot's going to happen this year.
James, do you see it as a fairly unique time at the moment with the Australian stock market, with what's happening in Europe, of course, but blue chips and what's happening with the blue chip Australian companies? Because it used to be just a case, well, put your money into blue chips and sit back and nothing can go wrong. Or
even the index, just the strong returns from the index, capital growth and dividend yield combining to give you about 12%. On average, and look, let's be careful of averages because Steve Waugh made the odd duck on the way to his average of 50, but that's been a very strong driver of people's faith in the stock market. But it's really tested at the moment with this, as I said before, this incredible volatility. Share investors are really hostage to some amazing turnarounds in sentiment. People can think the worst is over and the markets jump a while, and then there'll be another news piece of data that comes out, and then they fall in a heap again. So sentiment is just driving the show at the moment.
And it makes, that's the thing. It's a liquid asset. Whereas, illiquid is property. In a sense, it's hard to transact. So when you're seeing these sort of events occur, people are panicking, the sentiment kicks in, the negativity kicks in, and we see this volatility. That's the difference, I sort of say, in a generalised sense. You don't get that volatility in property. It's an illiquid asset.
We got a flood of questions when the European markets went down a few weeks back. We got a flood of questions. Does this mean the auction clearance rate's going to rise tomorrow? Is everyone going to leaving the stock market and entering the property market? So I spent a lot of time explaining, you take time to select the right stock. You've got to take time to select the right property, and it does take time, and transaction costs are higher. So no, there's not going to be a transference over a period of 24 hours from the stock market to the property market.
I suppose I could sum it up by saying shares do really well over the long term. They're probably not going to do really well over the short term, and investors shouldn't try to compress that return from shares into the short term. Give equities the time horizon they need, 5, 10 years and even onward, and they'll be good performers. But people have to understand it's really being bashed around by sentiment at the moment.
Gentlemen, thanks for joining us on Melbourne Property TV.
Thank you.